So options, a much discussed topic and probably one of the most misunderstood aspects of modern investing because for most people, uh, they look at it as some new way to get rich quick. And that ain't my bag, as Austin Powers used to say, right? It's not my bag, baby. So, I have the same rules with everything I do as an investor. And before we turn on the recording here, I got a sense of where everybody is as an investor in terms of options experience. Frankly, I would say that no matter how much options experience you have, uh, I think that you're going to be able to get something from this because my approach to options is, from what I can tell, having used them in other people's portfolios when I was an advisor until 4 years ago we sold the firm, and now I'm a researcher and a publisher. But for decades now, I have used options a lot. Uh, and I've used them individually. I've used them strategically in portfolios that I've run. And those of you familiar with our institutional portfolio, which I'll kind of show you into today to highlight the options parts of it, because that's one important application of it. I think I think you'll start to see there's an infinite number of ways to use options. Uh, I have yet to find anybody who really thinks of them exactly the way I do, and I guess that's what makes a market. Um, and I also think it's why more people should know about them because they are not scary. In fact, they're the opposite of scary. They are the best tool that an investor can have if they're a long-term investor that has that is if you're a long-term investor and you're not at least a little bit concerned about how much money you can lose along the way, options are a great thing to know the basics of. And it's not very hard to learn. And if you are a conservative investor that says, the one thing I wish that I could do a little bit better. And by the way, this has been me for a lot of my career. Conservative investors say, well, how do I try to make it so that when everybody is talking about how much money they're making in the NASDAQ or in NVIDIA, that I can try to get a piece of that too. But I'm a conservative investor, so I really don't want to lose. These are all emotions about investing that options, if handled correctly, might be able to solve. So with that, and look, I say this all the time, but I really, really mean it in this case. Let's make this as interactive as you want it to be, because I think there are a lot of different levels on here. And as I was putting together kind of my notes for this and thinking about how I wanted to present it, I was getting pretty excited because I just feel like this is a whole area in which investors have been so miseducated, and let's see if we can start cleaning that up a little bit. All right, so let's start with the basics. Okay, what is a put option? What is a call option? Very simply, any option is a contract. Is it a contract between you and another person? No. It is a contract between you and basically the options exchange. And there's something called the Options Clearing Corporation, which handles all of it, and there's dealers, traders, and all that stuff. This was one of the first questions my clients back in the day would always ask me about options. They would say, well, wait a minute, but what if the other side does this or that? It doesn't matter. You're part of a marketplace. But essentially what an option does, and I'm looking around here for something I can hold up. Let's see. I have some old baseball cards lying around here. Okay, anybody remembers Darryl Strawberry from the Mets? He's the one I just happened to pick up. Okay, got a pretty big card collection. If anybody knows how I can sell it, it's worth a few pounds. Anyway, it's like saying, hey, I have a call option, and this call option is like a ticket. It says, I am going to be able to sell XYZ security between now and a certain date in time called the expiration date. And I can sell it at the strike price, call it $100. I can sell it for $100, but I don't own XYZ. I own this ticket, this contract that says I can do that. So I've got a limited amount of time. Thank you, Mr. Strawberry. You can sit down now. So a call option allows you to do that with the idea that something you expect something to go up, and that's how so you have a call option contract. It gives you the right, if you want, to buy something at a certain price. A put option allows you to sell something at a certain price, which basically means that if you buy a put option, you are doing it because you think something's going to go down. Now, there is another side to the options game, if you will, and there's selling options. I'm going to talk about this very briefly because, frankly, I tend to buy options and sell them. Like I buy ETFs and stocks and sell them. And that is, I think, what's a little bit different about my approach. There's a big, big, big industry right now, and a lot of ETFs are trying to compete with each other to do it in what they call selling covered calls. That means that you own XYZ. Sorry about that. You own XYZ, and you would like to try to get paid a little bit of extra money. And so you say, I am willing to sell XYZ if it goes up to a certain price because the options market, the other side of the trade, is giving me some money up front now as compensation for taking the risk that I might have to sell this thing if it goes up. And it's the opposite on the way down. And look, there is, I want to skip past the basics fairly quickly here, just so you know. I mean, there's so many places you can learn about the basics of options. The best one probably is from the Options Clearing Corporation. Back in the day, before the internet, we would all be handed a book and updated regularly from the Options Clearing Corporation. It was called Characteristics and Risks of Standardized Options, and you had to know it. So you couldn't get a license to be an advisor or a broker without it. And if anybody would like me to, sort of have a little list of option resources, just let me know, and I can put that up as a follow-up. Okay. So we talked about puts and calls, but I think when I get to the live examples, I think it'll make a lot more sense because I do not want anybody to get caught up in the terminology. Okay. The strike price is basically the price at which, when the option expires, that's kind of when you settle up, okay? And I'll wait until I can give you some specific examples. There are three other things that are a pretty big factor in options. One of the main ones is volatility. If you've ever heard of the VIX index, if you haven't, VIX, please look it up at some point. But VIX is the volatility of the S&P 500. Well, every security has a VIX or a version of a VIX. I actually use that in my own calculations for some of the quantitative analysis that I do. I want to know how volatile something is likely to be. Everybody knows the VIX. The VIX is based on the S&P 500, and it basically is estimating how volatile the market will be in the next, I believe, 30 days. Now, the thing about volatility that people come to understand is that when volatility spikes, that is usually synonymous with market going down or security going down. If volatility on NVIDIA was 20% a year, all of a sudden it was 30% a year. Now it's, I don't know, probably 60% a year. Okay. So it would have a vol or a volatility of 60%. All right. The Greeks. There are 1,001 places you can go where they will talk to you about things like gamma and delta and all this. Okay. True confession from Rob Isbitts. I barely know what they mean. And I'm not afraid to admit that because I have gotten by for 30 years and been actually fairly successful, you know, for what I was trying to use options for. Because like any investment, working with options is not about, oh, how much money can I make? Now, if that's your objective, great. But if you don't care about risk, fine. I have always looked at them a different way. And as such, I skipped past the whole Greeks thing. I never studied this formally except to pass my licensing exams. I also don't have a gut feel for it. I always look, well, you know what? I won't steal my thunder. I'm going to get to in a minute. And liquidity is important. Now, liquidity in the options market is through the freaking roof right now. Okay. And I will show you some examples. Those are trades I actually did this morning. I said, oh my God, I can actually buy an option on that. I would never have thought it would be that liquid. It's an oddball security. It's a levered ETF. And the way you can tell how liquid an option is not how much it trades. By the way, ETF, same thing. Stocks, really same thing. But you know, a lot of people mistake ETF liquidity for how many assets are in it. Has almost nothing to do with it. And options are the same. It's how easy is it to buy and sell close to the same price. Okay. And I will point that out when we get there. All right. So for instance, with the ETF example I give, it's funny, my good friends at Seeking Alpha, they said, well, we'll take on an article that's at least, if it's a stock, it has to be at least 100 million in market cap. But if it is an ETF, it has to be at least 100 million in assets. And I said, well, a stock with 100 million in market cap is tiny, 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 tiny. It's like micro cap. An ETF with 100 million in it is not big, but it's definitely not small. So, yeah, I said, boy, you know, 100 million in a stock market cap is kind of like an ETF that owns, I don't know, probably 7 to 10 million in assets. So it's, you know, liquidity, because all that matters in ETF is if somebody places an order to buy or to sell, can a market maker put that basket together without a lot of price slippage? Options work the same way. As long as the bid and offer side, if you will, are not miles apart, I'm willing to look at it. And as opposed to a lot of people, liquidity to me, I am much more concerned with, do I think there's a good chance that what I think is going to happen, something's going to go up or something's going to go down within a reasonable period of time? I don't mind if the spread's a little bit bigger. I will put in a market order. Now that is different from what most people would tell you. Oh, you have to use limit orders and this and that. It's like, you know, all I can tell you is I've done, I don't know, maybe 20,000 option trades in my life. Never really had an issue about that. If I see that something's very illiquid, I just won't trade in it. Okay. So those are the basics. Let me stop for a second and see if there are any basic points that anybody wants to make sure that I qualify but before we are done today. Anything from that first part of it?
Rob, I have a question. This is Shelley.
Yes. Hey, Shelley.
Hey, so you're talking about liquidity, and you said it's basically how easy it is to buy and sell at, you know, at a similar price.
Yeah.
How do you know that? Or did you explain that? I'm sorry if I
I
missed
will,
it.
the examples, I will make
Oh,
sure I
we'll
discuss that.
illustrate.
That's why I'm
Okay,
glad you asked, because
got it.
now I will absolutely make sure that I point that out, okay?
Okay, thanks.
This is why I'm going to actually, for the first time, I think ever, and I'm sure it's something I couldn't do when I was an advisor. I am going to just literally go into one of my accounts. In fact, I'm going to do some live trades today in my own account. And so I will, yeah, I don't think I've ever done that. And we'll see. Look, maybe it'll turn out to be, you know, a good way to teach this stuff. All right, so we talked about the basics. Now let's talk about motivation. Why would somebody want to learn more about options? I say learn more. I mean, most people have heard of options. Even if you have used options a lot, I'm going to guess, and I'd love to hear from people like Jerry and others who've done this for a bit, if this really was different or if I just think it's different. Okay. So modern markets have changed things. And the reason is markets can turn on a dime. Now, you don't need me to tell you that. Just look at the last, I don't know, 3, 4 trading days. You know, whether it's what they call short squeezes or you know, a politician said this or a bank came out and said this or whatever. It could be anything. Markets are skittish in ways that they've never been before. And skittish to me means opportunity, but more than anything else, what's my number one rule? Avoid big loss. Okay. Risk management. And so I use options for risk management, but sometimes risk management is actually using less capital. And I will get to that in a second. So modern markets, very different. To me, options are nothing more than a logical tool. Okay, and you'll see why I say that. Okay, swan. I'm not talking about the bird. I'm talking about the abbreviation for the phrase "sleep well at night." Okay, I always sleep well at night because unless my portfolio is, I don't know, 95% in T-bills, which I don't think it ever has been. I've always got some type of disaster protection in my portfolio. Okay, it is no different than why do we buy term life insurance? No, because you know, just in case, right? When you're 30 years old, you don't think that you're, you know, gonna pass quickly, accident, whatever. But you buy it, it's cheap, and you hope you don't need it. In this case, you might buy that protection and it's cheap. And I'm talking about, you know, buying what they call tail risk or way out of the money put options. And I'll show you an example because I have some of those right now because I always do. I want to be the one. Look, I talked about this at one of the other sessions. In 1987, it was my still toward the end of my first year in the Wall Street business. I was working in the World Trade Center for Japanese Bank, and I still remember getting the call October 19th, 1987, and it was the day that led to a 22.6% decline in the Dow, which really was the market back then. The S&P wasn't nearly as well known, even though it existed. And now, from that point on, I said to myself, okay, maybe this will never happen again, but if it ever does, I don't just want to protect my portfolio from that. I would like to first protect and then use it as a crushing the market tool. And that is how I tend to look at it. The analogy for you football fans, American football fans, I know we have a global audience. If you are 4th down and inches to go for a first down, you give the ball to your big running back, you're at midfield. And you hope, first of all, the goal is that he gets a few inches and gets to keep the ball. You don't have to give it to the other team. But there's no rule that stops that running back from making another 10, 20 yards, maybe even taking it all the way to the end zone, 50 yards for a touchdown. That's how I look at tail risk options. That is also how I look at options in general on the trying to make money side, the call, the call option side, but especially on the tail risk side. I like the idea that there's a limited amount of money that you put up, and but there's an unlimited amount that you can make. That's what happens when you buy options. When you sell options to you own a stock, you write covered calls, you automatically cap your upside. Now, that said, if somebody wants to hear about it this time or another time, I can talk to you about how I get around that problem, because I have had situations where I've owned a stock, I've had covered calls against it. I know the stock's going to get called. Well, I mean, there's ways that you can mitigate that situation without sort of throwing good money after, or bad money is good money after bad, right? Okay, options also, and this is some of the trading stuff I'll show you. It's my alter ego, because it's a place where, and the account I'm going to show you, I wouldn't call it a mess around account, because it's real money to me, but it's a place where I'm willing to take risks that I wouldn't take in a bigger portfolio, and I certainly never would have taken with other people's money when I was an advisor or a mutual fund manager. But one of my favorite expressions is take big risks with small amounts of money, and a lot of the options work I do is that way. And so they're kind of like a garnish, a complement. All right. Now, higher bond rates. Why am I saying higher bond rates make it that you should be motivated to learn about options? Because I don't know how long we're going to continue to have 5% T-bills, but the idea that you can put your money into a T-bill and make 5% out to a year, think about it. Just theoretically, if you took 97% of a portfolio, let's say $100,000, $97,000 goes into a T-bill for 1 year at 5%. Well, the 97 out of your 100,000 you started with, 97 is going to grow to more than 100,000. It's going to grow to about 101 and change. Okay. You've now got $3,000 left. Do whatever you want with it. You could lose all 3,000 and you'll still have more money at the end of the year than you do now, because the 97 becomes 101 and change, and the 3,000 you become whatever you want. That's another place where I've started to use options because I've locked in a return, but there's a lot I can do with $3,000 out of 100,000, as you will see. Now, you also, you can't say I'm going to take that $3,000, put it in options, and lose it all in a day, which is also easy to do if you don't know what you're doing. But it's all portfolio management, it's all risk management, and so that's why, to me, high bond rates and the combination of being able to lock in fairly secure rates, we're talking about T-bills, and use options at the other side. To me, it might be the coolest barbell approach to investing that we have going. Indexation is the other reason. One of the reasons markets can be so whippy is that indexes tend to dominate a lot of the trading. So indexes and day traders. So what do I mean by this? Recent activity, the Russell 1000 index, the small cap index, main ticker symbol is IWM. That thing's been on like a parabolic move after, in fact, if you read my my commentary yesterday, hope everybody appreciated the tongue-in-cheek revenge of the turds. Small caps have been turds for a while. And all of a sudden, they and the Dow stocks and, all the stuff that was kind of left for dead by investors. Well, you know, that's going to happen. It happens so much more now than before. And it happens the other way too. Nvidia sells off 10% in a day, and the next thing you know, it's back in 2 days. Well, options are also a great way to say, I think something volatile is going to happen soon. And I'd love to be there when it happens, but I don't want to go, just take the Nvidia example and follow that. I don't want to go buy hundreds of shares of Nvidia. It's a lot of money. But boy, I can buy an option that basically says if Nvidia goes nowhere or down or only goes up a little bit for next couple of months, I'll lose the little bit that I put up. But if Nvidia goes up at least, let's say 10% in the next couple of months, which it tends to do a lot, I can make a lot of money off the small amount I put up. Now, some people would look at this and say leverage, speculation. No, I'm saying it is a surrogate. And it's funny because I had the word surrogate on here, and I think I put something else in here, but it is a surrogate for taking a bigger position in something. And so I always look at it as reward to risk ratio. And you get a lot of that in the options space. But everything I do is I say, how much am I risking? How much can I make? And going back to that little alter ego part here, okay, a lot of the stuff that I do, I'll show you how I use, I'll show you how I used options years ago. I actually have an example down here from more than 10 years ago. It's a trade note that I wrote to my clients back when I was an advisor, which kind of sums up, how I started to use options back then. As I started to get a little bit more free time, a little bit more free space, writing about this stuff, not having a client base and the fiduciary responsibility, which, after we sold the firm 4 years ago, I started to look at, geez, there's got to be other ways to use options. And of course, these modern markets and the indexation, all the stuff I've talked about, it all made it easier to say, hey, I can find reward risk trade-offs where I think that I've got a really good chance. And even if I'm wrong, if I'm willing to lose what I put up, which is all you can lose when you buy an option, okay? But again, I'll show you in the examples in a few minutes, but that's the issue. So how do I use them? I call it a meat and potatoes approach, as I kind of discussed before. I do not make them complex. I don't speak the Greek language, and no offense to the Greeks, but it's the ancient Greek letter, the Greek alphabet that a lot of people talk about. I can't stand newsletters that intentionally tug over people's heads because everybody wants to show how smart they are. Okay, I don't count on being smart. I just count on being straightforward. Anyway, I do not make them complex. That's why it struck through here. Okay, I do not make them high risk. Yeah, I can lose 100%. I'll show you in a minute. I've had some big percentage losers just recently in the options work I do, but the amounts were so small relative to my portfolio. It was worth taking. In fact, let me do a quick example right on here, okay? Let's say that you put, and I'll just use round numbers, okay? Let's say I was using this to hedge a portfolio, a full portfolio of equities, and I decided I was going to put 1% in put options on SPY. All right, and I'll show you a current example of what I'm calling this. If I took 1% of the portfolio and put it in that, and it all went down, okay, the market just kept going up and up and up, or it didn't get to the point where my put options at whatever their strike price, okay, the market didn't fall that far. So that becomes a 1%. I just lost 1% of my entire portfolio. Oh heavens. Well, the other way to lose 1% of your portfolio is to have 5% in a stock or an ETF and see it drop 20%. It's the same mathematical impact. 20% of 5% is 1%. 100% of 1% is 1%. We can take this further and say if you had a 10% position, copy that down. I have 10%, I probably never have in an in an ETF, and it fell 10%. Well, that happens all the time. These are all the same dollar loss. And that is when I talk about reward risk trade-off, okay? Personally, I am not afraid to have a single part of my portfolio cost me 1%. It's not what I prefer, but I will risk worst case 1%. And that's why a lot of times when I say, okay, what is my risk tolerance? Well, for an ETF, once it gets to 10% loss, I'm starting to wonder, maybe my research was wrong, my analysis was wrong, okay? Or at least temporarily wrong. I don't really talk wrong and right, but it was early, it was off base, don't know, I missed something to be off by that much. Same thing with the stock that's down 20, although frankly, I start looking at stocks when they're down 5, in our York portfolio. If it's down 5, I'm starting to look. If it's down 10, I'm starting to really look. And I try not to let them get down to 20 unless they're very small positions. Because again, if this were a 1% position down 20%, like if I said to somebody, would you rather put 1% in an option and have it go to 0, which often happens, or would you rather have a 5% position in a stock and it drops by 10%? Okay, well, you take this all day long. It's a fractional loss, all right? So I think this is important to kind of warm yourself up to approach options. And then from there, all the examples I use hopefully will be a breeze, okay? And I think what I just talked about here is what I underline. Define risk. To me, one of the greatest free lunch in investing is not diversification, because diversification today is a very screwed up word or phrase because people think they're diversified and they're not. The S&P is not nearly as diversified as it used to be. Same with the NASDAQ. There's a lot of things that aren't very diversified. To me, the free lunch is at any point in time, whether you are using a stock, an ETF, or an option. The idea that you can say, all right, if I put 1% in an option, I can't lose more than 1% of my portfolio. If I put 5% in a stock ETF and I say, and again, it can run through this level, but I'm saying normally if somebody doesn't get to down 20% in a heartbeat, you've got a little bit of time to reevaluate, okay? And same thing with this. So to me, the fact that we can do this and we can position size and define our risk, that to me is the free lunch in investing. But somebody, I think, has to either explain it to you or you have to learn it on your own. And I do not think Wall Street is teaching this. Instead, they're teaching diversify, own different types of stocks. Well, we're currently recording this in July of 2024 at a time where there actually has been some diversification effect for like the last 3 trading days. Okay, the Nasdaq's down and the Dow's up and the small caps are up, but 95 to 98% of the time, especially in the worst of times, when stocks get hit really bad, they all go down together. Okay, none are spared. So diversification to me is really an overplayed hand, and it's an excuse for a lot of people to collect advisory fees. Okay, done with that. So It is supplementary. My options work as supplementary. It's never the main feature. The main feature is stocks, treasury bills, ETFs, etc. And then there's two things that we can do. I talked a lot about the tail risk, so I won't belabor that. I guess I talked about the enhancing return part as well. These are the two reasons. You use it at the margin. So basically, if you say, okay, my range of returns is, let's say, from here to here. Well, adding a little bit of call option exposure or put option exposure in a down market, okay, can boost your return a little bit more. It may pull a little bit off your return, but again, it's controlling. The math of this is much more important than the Greek mythology that people use for this stuff. Okay, let me stop there because now we're going to fast track and get into the real specifics. I'm going to name names, as they say. I'm going to show some real examples. Let me just see. We have something in the chat. Okay, great. All right. Any questions about what we've covered so far? Because now I'm about to go on speed read here. Okay. So let's walk you through different ways we do this. All right. So this right here, and I'll see if I can expand this a bit. Told you I was very excited to do this one because it's a very different way of teaching than I'm able to do with other subjects because it's hard to PowerPoint this stuff. I just don't think you'll learn enough if I PowerPoint it at all. So instead, I'm going all the way down to pulling from past examples and in a few minutes doing some live trades. So back in 2013, this is a little snippet from what is a document that has, I don't know, thousands of lines in it, okay? In the core portfolio that is part of the institutional service. I've run it in different forms since really the late 1990s. I've run it as a mutual fund. It's had stocks, it's had ETFs, had mutual funds back in the day. I mean, before ETFs gave you enough choices like they do today. But from time to time, including now, I've also used options. I sometimes use call options, but in the staple of this portfolio, didn't use it all the time, but this was one example. Okay. I can't remember exactly what was going on in 2014, or I should say in late 2013, but I got to the point where I said, okay, most of my portfolio is, let's say, conservatively bullishly positioned. Okay. And yes, this is laughable. SPY at 170. Okay. 10 years ago, 11 years ago. All right. SPY's at like 565 or something right now. So should have just bought and hold, right? So what I did is I said, okay, as an overlay with 1% of the portfolio, just like I showed in the example, up here. I added to the portfolio, which at the time was probably stocks and ETFs, if I had to guess. I bought on this date a SPY put option with a strike price of 170 due the following June 21st. So what does that mean? It means that, and I'm going to guess that the market was probably, I mean, SPY terms, 1/10 of the SP 500. So maybe the S&P was at, I don't know, 2000, 1900, something like that. So I said, okay, if this thing really crashes, at some point I want to start making money to offset what I expect will be some losses on the equity side of my portfolio, whether it's through equity ETFs or individual stocks or both. So I used 1% of the portfolio. So this is the most I could lose. And say if the market goes down between this date that I bought it and this date that it expires, this ticket, remember holding up the ticket, okay? So this basically says you have a ticket that says you can sell SPY for $170. And there's a multiplier. And again, I think read about the basics of options. All right. One options contract here was this, multiply it by 100. So one options contract would have cost $1,027. And it would have basically said that if the market drops below 170 on the SPY, I effectively have the same thing as being short $17,000, 170 times 100. That's the multiplier. So this was hedging with 1% of the money in the portfolio. This was hedging a fraction of the portfolio. Okay. And I paid, this times 100 for it. So here's the explanation. This move allows us greater flexibility in how we hedge the portfolio in the months ahead. Options transactions are less straightforward than simply buying and selling stocks or content. Okay, so it was just us being good service people to the clients. So, and I have plenty of other examples, but I just wanted to grab a simple one. So what happened after that? Pretty obvious to me that the market just kept going up, which was great for the other 99% of the portfolio. I'm sure I had some hedges in there too, but anything I was using to play offense as opposed to defense probably did okay. Why? Because we were only a couple of months into this. We still have plenty of time left. And for reasons I cannot recall, I might have swapped this to another option. That's probably what I did. But I sold it. I sold it at a 70% loss. So it cost the portfolio 0.7%. However, I probably had 50, 60, 70% of the portfolio in things that were going up by that much. And what happens is you start to get a little bit closer to your expiration date, and it was just a little bit closer. But I say, I'd rather take this money and redeploy it, whether it be into buying put options at a different strike, a little closer to the market, something like that. All right, so that's how we did it. Okay, now fast forward. Okay, this is a snapshot I took, I don't know, a couple hours ago. This is the trading side of things. And I will come back to this as you see over here, but I just want you to see kind of the world of options, all right? Because sometimes people look at options and they see the percentages and all that. At the end of the day, it's really the dollars. Like I said, in this example up here, right? So this is a summary just in the last couple of weeks, okay? And you can see I've been fairly active here, okay? 27 trades in 2 weeks, including a holiday, so like 9 or 10 trading days. It's, and look, there are times where I'll make 10 or 15 option trades in a day. Depends on how the markets are. It depends on how urgent I feel it's time to act. If I'm investing, how much of it is investing and how much of it is experimenting. Like I said, I do a lot of experimenting with options. A lot of stuff that I may buy eventually for for one of the bigger portfolios in ETF or even stock form. I may test it out by watching it trade, through owning options. There are also a lot of things I can't put into the institutional portfolios because there's a chance that I'll be in and out of them so quickly because of how they're struck. If you don't go out too far with an option, if you buy one that's out a month, that's not, it's going to be volatile every day. Okay, so great. I like to keep score, and it's good that 2/3 of them ended up nicely. But as you can see, options move a lot more sensitively unless you go way out in time with them. Okay. But look, it's all about the math. Okay. I mean, in this case, I took, and I mean, I think this account probably had, I don't know, we took some money out of it, but we had, I don't know, $18,000, $20,000 in there or something like that. Okay. Well, in 2 weeks, I turned the whole thing over. Okay, I traded 22,000 on a portfolio that, had less than that. And there's some open positions, which I'll actually show you in a minute. And made a few $1,000s. I'm showing you this just to show you kind of the mindset of using options, let's say at the margin. What you see here is Schwab does a nice job of outlining what the trades were. And I actually don't exactly know what the circles mean other than, they were up or down. I don't know if actually probably the bigger circles are bigger positions. So these were bigger dollar losses and these were bigger dollar gains. Okay. And there's a mixture of both. And look, I'll be honest with you. Okay. And the stuff that I do that I put out in the institutional service. Okay. I'm always watching that. If I take my eye off of anything for longer than I should, it's in this stuff because that only, affects me. I'm not a fiduciary anymore, but I do still think like one. Okay. So now let's go into, I want to show you how we do this in the institutional portfolio, but I also came up with this example. I'm wondering if it's going to be a little bit too, no, I don't think so. Okay, so this is a quick example of how this is an actual trade I did in the core portfolio before we started the institutional service, but remember, I've been running this for the advisor that bought us. I kind of model signal service for him. So let's see, on the 15th of December last year, I bought 1 year put options. So now it's going to be a lot less volatile because it's got a year to turn out. The strike price was 460, which meant that for every contract, it was $46,000. Not that you're spending, okay, that it's covering. It will act like $46,000. It costs $20 a contract or $2,000. So effectively, it costs 1% of the portfolio to simulate a 10% short position if the market reached this level, which of course it didn't, it's gone up from here. But again, it was a level of risk I was willing to take. I was willing to burn, 1% to have a 10% tail risk hedge. And this was a starter position, and then I can build on it, change it, etc. Okay. The idea is when you have something like this in hand, I'm not so much worried about the market going to 4,600 on the S&P. I'm more concerned about the market going to 3,600 or 2,600. And that's what I'll show you here. Okay. So, and again, look, we're here to please. So if people want me to go into more depth, not today, but do something else or try to work something into the service, on option ideas, constructing things, options education, happy to do it. I certainly spent a lot of time on it. So what I did for our advisor friend that I did this for, and also for myself, so okay, for every one contract it costs you $2,000 in this example. Okay, it was $20 a contract. Again, it costs that much per contract because we're going out a year. If I went out 3 months, which is probably a little more closer to what I often do, go out 3 months, it would have cost a fraction. It probably would have cost $6, $5, something like that. Okay, so it's costing in real dollars $2,000 to buy one contract to effectively hedge $46,000. So if all I owned in my portfolio was SPY and I owned $100,000 of SPY, if the market crashed, half of it would be covered. And the funny thing that happens is the sooner it falls hard, the more the market starts to anticipate it could get worse. And that's what I'm going to show you here. So this is what we call the intrinsic value. Again, I told you I'm going to spare you a lot of the terminology. The intrinsic value is technically what it would be worth today. I'm sorry, if you settled up today, okay? So basically, look, when you got a year and the market is, I probably should have put down where the market was at this time, but yeah, I'm sure it was, I don't know, probably in the 5,000 level, give or take, a little less. I, uh, you know, if the market were to close on this date above 460 on the SPY, this has no value because my ticket says I can sell it at 460. Well, so what? If it's trading at 50 to 565, like it is these days, this means absolutely nothing to be able to sell it for 460. Okay, so that is how you lose the money you put up. And you'll lose let's say a fraction of it, the closer you get to this level. Okay, the closer you get to expiration, the less valuable that is if you're not in the money, as they say. If this were a call option, I'd be looking for it to be above 460, but it was a put option for a tail risk hedge. And so it is most valuable when the market's either below 460 or it's worried about it going to 460 by this date. That's how I would put it. So what I did is, yeah, I put whatever break-even levels and things like that. Okay, and like I said here, if the market crashes to 400, okay, I figured out that the options would add about 1% to the total return. If the market crashed to 300, which really is the sleep well at night factor here, it would add 3% to the entire portfolio. So let's stop there for a second. That'll be the end of this example. Okay. This is the sleep well at night crash protection tail risk that I do in these portfolios, because to protect in this way, yeah, I love inverse ETFs, but you have to buy a lot of them and they go one for one against you. Well, to the extent that I can use options for this, in this example, okay, here, I assume that the portfolio had $460,000 in it, all right? And so I said, all right, I'll spend 2,000 out of 460,000, because if the market crashes by whatever it would be, 30 something percent, okay, I'm going to make 3% on the total portfolio. Okay, I'm going to make $14,000 on this at a time when the market is cratering. That's pretty significant, and that's only with 10%. Imagine if we got more serious about the hedging, so I'm going to hedge half the portfolio. Well, in that scenario, multiply it by five. Yeah, 5. Okay. Having, picture yourself if you look at your statement and it says, or your online, it says, oh, red, red, red. You got brackets everywhere, but then you got this plus 70,000. All right, on a portfolio like this. All right. Generally speaking, conceptually, that's why I use options for that. Okay, let me stop here. The last 2 things I'm going to do are I'm going to briefly show you, using the live examples, what I'm doing in the institutional portfolio. And then I'm going to get to, and like I said, I'm going to walk you through live a couple of trades that depending on how quickly I go through them, I may close them out 5 minutes after this call because I want to show it as an example, but I don't mind doing that. Any questions on anything we've talked about here? Otherwise, I'm going to go over to the institutional. All right, check the chat. Nothing there. Okay, good. Hopefully, well, I see some people definitely aren't asleep because I can see your face, James. So thank you for what they used to say in that old commercial. Thank you for your support. All right. Okay. So this is, frankly, a live look at what's in the institutional portfolio. If you're not a subscriber to it, I mentioned on the last call that on Monday that we are trying to figure out ways. Let's face it, this is my best work. Okay, I love ETF yourself. It is frankly designed for people to learn the basics of portfolio construction and learn more about ETFs. I think you can tell because there's no options or stocks involved in it. You know, there's a lot more to how Rob invests. Okay, this is in percentage terms what 90% of my portfolio looks like. Okay, we probably have some T-bills, chunk of T-bills that are outside of here. And I have my option stuff, and I have another trading account that, which again, it's one of those things where, when I go away for a few days, I make sure that I'm not fully invested because things can move that quickly. Okay, so I have a trading component. Although again, using that football analogy, everything I buy, I hope it goes to the moon. But I'm such a risk manager instinctively that I take profits in chunks when I can get them. So anyway, I've got this whole portfolio here. There's three parts to the institutional service. Okay. And for those of you who haven't seen, I think we'll probably do a separate webinar on this one. Stocks in different rotating sizes, but think of it this way. Rob's got a stock portfolio, okay? And that stock portfolio needs some good tail risk hedging. So with the S&P in the, I don't know, 5,600 or something like that, okay, wherever we are, a bit above this, I have a put option contract. XSP is just the SPY is an ETF that tracks like 1/10 of the S&P 500. This also tracks 1/10 of the S&P 500, but it's an index option. They basically created this, I think, to rival the SPY. So they kind of work the same way. And I haven't talked about the tax implications here, but one reason is if you have a taxable account, and I'm not going to give any tax advice here other than to say that if you can buy two different versions of what's essentially the same thing, then you don't have to worry too much. You give yourself a little bit more sort of grace room before, like if all I were doing were buying and selling the same SPY contracts, I'm pretty sure that would end up with a lot of short-term gains and all that. And so using different symbols is sort of a advanced part of this. So anyway, I own I used I guess what about 0.5% of the portfolio to make it so that if the market really craters by mid-October, that I will protect this portfolio. Now I can also reduce my equity holdings, but this makes it so that I don't have to worry about sudden jolts in the broad market as much. Because it means that I can try to pursue more dividends with this and all that. So that's how I'm using it there. At the same time, I've learned the hard way that you can never just assume that the market's going to roll over, even when my trusty charts tell me. So back in April, I in addition to having this protection, okay, matter of fact, that's a wrong date because we just swapped this, but right now, if the S&P flies over, or the SPY flies over 600, I actually have something of value, and I will show you because okay, this was the original one we had. I bought here. Okay, I sold it a few days ago. All right, these were 570 call options, so 570 strike price, expire at the end of September. These things, and I think if you saw the note I put out, okay, I didn't talk about this security specifically, to be fair to the subscribers, but, you know, I made about 93% on this, in about 3 months. And I basically swapped it and said, okay, market, the call option side has been nicely profitable. It's added a little bit to this sort of mundane dividend portfolio. Not so mundane lately, but generally mundane. And now I dare the market to go up, not to 570, because I bought this when the market was at like, I don't know, 520, 530. And oh my God, it actually, you know, came close to hitting it. That boosted the value of the option. Because again, we're a long way from here. So as you get closer to this, but you're still far away, the other side of this, if you will, or how options are priced mechanically, says, hey, there's a really good chance we get above 570, and that lifts the value of a call option. Okay. So then I went and I dared the market again. Again, small amount of money, but now I've got it both ways. So I like to refer to this as putting brackets, well, I guess brackets around the portfolio, but it's not really a bracket, it's wings. I would say wings, okay? Because I've got my basic, and I mixed up the two of them here because I do it in two portfolios, but again, trying to keep it at the concept level. I have a stock portfolio. That is the core of what I'm doing, plus a chunk of cash. And but if the market goes parabolic up, I want a little extra return. If it goes parabolic down, I want to protect and basically add some value to the portfolio. What would be the perfect scenario? That the market flies higher, just like with the one that I showed you down here. The market flies higher. I cash this one out, make more. Maybe this happens, I don't know, in the next month or so. And this one's still alive. And then the market rolls over and crashes to 400. This thing's going to be worth a multiple of what I paid. So you can make money both ways. And it's a matter of different time frames, things like that. All right. I also use this in the core model the same way. Not always. I'll always use it in YARP because stocks are different. And but I also use it in the core ETF portfolio. I do not use it in macro track, so I will skip that. We'll do another session on that someday. Okay, so here's just a kind of quick look. I showed you that bubble graph before. These were all the trades that went into it. Okay, and like I said, I don't know, it was $20,000. Remember these numbers we showed. Okay, so you know you take, if you will, a circuitous route to get there. Okay, what is it that I'm buying and selling? And again, this is I won't call it a play account because I don't play with money, but look, you know, Walgreens Boots Alliance. Okay, his stock has been absolutely crushed. Well, you know, everything gets bought on the dip. Why not Walgreens, a company that's, you know, making a lot of negative headlines? If it gets above 12.5, and that's where I can start to bring in I'll do a couple examples of this, then we'll do, a live trade or two, and then we'll call it. Here we go. Okay. So there's Walgreens Boots Alliance. Let me pull up a shorter term graph. Okay. Remember, we'll do one on technicals too. I know we have them coming up in a couple of weeks. So I don't know, somewhere around here, I probably start to say, okay, there's at least a hint that maybe this thing will rally. So can it get to 12.5? It's not too far from here, given that not too long ago, last month, it was at 15. Okay. This is the closest thing I get to speculation, but how much money did I spend on it? Okay. I spent, let's see, 600 and, no, I started with 5 contracts, about $300. I added another 10. I sold them. I made some money. okay? So whatever, small profit on that, high percentage profit, and did it again. Didn't work out. I'm messing around with this right now to see, okay? Because I don't own the stock. I'm curious. I've seen so much buy on the dip, and this is a market environment where, frankly, revenge of the turds, right? So that's that. Um, you know, I do some very basic stuff in here, like this one on the S&P. And then sometimes I'll get a little more exotic, like with the Bitcoin. Okay, you know what? I'm not a big fan of Bitcoin, but I'll buy call options, I'll buy put options, I'll buy an inverse ETF, I'll buy a regular ETF. I don't care. I just want to make money and do it without risking a lot of money, a lot of capital. So here I risked about $1,000, turned it into 2,200, something like that. Okay. Again, the key is the dollar amounts. All right. I would not be doing this by adding multiple zeros. Okay. Uh, and so it could be just about anything. And more recently, I've started to experiment, like you see here, and this is how it can go the other way. Okay, so just yesterday, I sold out of a position, which what's TQQQ? It's the 3 times Nasdaq up. Okay, so on a day where the Nasdaq gets crushed the way it did, for me, my $628 trade, I got out before it got any closer to zero and reset. But I've always got I don't know, probably 7 to 10 different positions going on at the same time. So I wanted to just give you a little bit of background on that. Okay, we have reached the part of the program where, if there's anybody still here, yes, people are still here. Good. Would you and I feel like I have to ask because I've never in my 38-year career done anything like this. As long as it goes well, maybe we'll include it in the recording. I don't know. I don't have the same compliance that I used to. But the last step here would be to go live into the account that I took all this from, and start to show you, how the whole thing comes together. Would anybody like to do that, or have we had enough after an hour and change? Just
Let's do it.
Yeah,
sure, go for it.
Sounds good.
Yep. Okay. Good. All right. So let me make sure that my Schwab account is up and running, and that I'm, frankly, only showing the account I want to show. And let me get it on the right page. Okay, it's called the spec account for a reason. All right, let me swap these out. And it's been an hour, so who knows, right? Okay, so yeah, we just when I do well in this, we bonus ourselves. So took a little money out of this, so we've dropped down to here. But again, look, and if I click on the realized gain loss, that's what I was just showing you through yesterday. So this is what's in it right now. And by the way, here's one thing to point out. Okay, I mean, look, it's a fairly modest account. All right, 16,000 change in it. Most of that is cash. Why? Because I mean, kind of crushed it the last few days with some of the stuff that I had, and that doesn't tend to go on for too long. So let's just take a look here and see. Okay, so I'm looking here, and I can do it in percentages or dollars. All right. Okay. And this is what sometimes it drives me nuts. It used to drive me nuts about the options market, but now I'm kind of embracing it because I feel like I have the skills to navigate this and the lack of greed to, not add zeros to this and put that kind of risk up. Just like when I love horse racing, but I'm the guy who bets like $1 to show, okay? Not $100 on a, you know, exacta something or other. Okay, so anyway, this is triple the Dow, all right? Well, one way to look at it is going to be volatile, okay? Uh, the other way to look at it is I only had to put up, a third of the money to get the impact. So this is kind of like, some people say options are leverage and triples are leverage, triple ETF, but I'm looking at the Dow, and I think I wrote about this yesterday. Okay. The Dow, yeah, I did. I recognize the chart, right? So if you hadn't read yesterday's newsletter, this would be a good preview. Okay. This is a really strong indication. It could always bust, but it's pretty good. And I've talked about how the Dow and the NASDAQ have these periods of time, especially if you go back to the year 2000. Okay. I'll tell you a live look, and I'd love to do more of these kind of live versions of the newsletter. It's faster than writing it. But in this case, okay, I mean, you don't see this, right? NASDAQ's doing this, and the DIA is doing it's like bizarro world, The NASDAQ looks like the inverse of the Dow. That's the inverse ETF, okay? So I looked at this and I said, all right. And I think when I checked before, the Dow was not even up this much. It was around the break even level. Okay, so Dow looks okay. This is a good sign. I won't steal thunder from the technical stuff, but there's a lot of good signs here. Okay, and again, this is the small money and all that. Well, if that looks bullish, well, that's going to look bullish. It's a very similar chart pattern. However, this is going by threes. So again, take big risks with small amounts of money. Well, actually, I got to get that back for a minute. So, this position here, and I literally just, I mean, my recollection is, I think I bought 10 contracts yesterday, 5 or 10 contracts yesterday, and I bought a little bit more, I think, early this morning. And it's like, look, I mean, you know, I don't sneeze at making $500-600 on anything. Okay, I will never have so much money that I would consider that to be. And at the same time, there's a lot of moving parts going on in this thing. I'm not saying it should get that complex for everybody, but like I got a lot of stuff going on. Okay, I'll sort this by symbol. So here's the Dow. All right. Well, I'm currently getting my patootie handed to me in small size. Again, big percentage, relatively small size. Okay. I start to really notice at $500, $1,000, and stuff like this. Because remember, what I should mention about options is when you own an option, and again, I always buy options and sell them. I don't do the short and cover thing. So this is exposure is what it is. All right. So let me take a regular one. All right. It's a GLD. All right. I think I opened, I've done a little bit with gold miners, took some profits on that, GDX. And now I have this. Okay. Look, these things are expiring in a month. So what does this mean? If I own 5 contracts, every contract is basically the same as controlling 100 shares. Okay. Kind of going back to the basics here, but I think it's worth it with the live examples. 5 contracts, 100 shares per contract. So this is the options market equivalent of owning 500 shares of GLD. But if I wanted to buy 500 shares of GLD with 500 times 240, that would be $120,000. So I want to spend $120,000, but I want to control $120,000. And cheapskate me, it cost me $573 to control the movement effectively with a little bit of a time element, but not too different from controlling $120,000. Some people would call that leverage. I would call it defining your loss. If this goes to zero, if gold just goes straight down when I was expecting it to go up, this is all I can lose. I can't lose 574. I can't lose 10 times that. I bought it. This is what it costs. Whereas if I had bought the same amount of gold that I would control, the notional value, as they call it, okay, then I would have had to lay out $120,000. And if gold fell by 10%, I'd be down 12 grand. No, I would have to do this, 20 times, and I still wouldn't be down 12 grand. This is why I love options, because they allow you to sort of maneuver. It's like you go into a crowded, I don't know, networking event, and you say, I want to try to get close to that. Maybe it's because it's where the food is, or the bar is, or a person, or the stage, or whatever. And to me, the options, like, I'm kind of sifting my way through the crowd, that may not be the best analogy, but yeah. So okay, so what this could change in 2 hours, or it could be sitting like this for another, I don't know, 3-4 days. Okay, but right now, what do I see in the shortest term time frame I can think of? I see potential for the Dow to go parabolic. And if so, what I'm going to do, I've already sold UDow calls for a profit at, let's see, where's my demos? Here, okay. Yesterday, I sold 10 of these, but they have 95 strike, not 100 like I have now. I invested this, it became this. This is my profit. It's close to a double. Okay. And hold on a second, make sure I've got this in the right spot. There we go. Back to here. Okay, good. I haven't been paying attention. Now, was it above or below 17,000? All right, so look, I mean, what do I see out there? I see Dow bullish. I mean, this has been out there for a little while. I'll give it a little more time to save itself. If not, I probably just dump these, take the loss, et cetera, et cetera. That's why that bubble chart looks the way it did. But look what I'm doing here. Okay, I literally just bought these this morning. Okay, and I did them as kind of a little bracket. Okay. So does anybody know what TQQQ is? I mean, I'll show you here. This is like, just like this is 3 times Dow, this is 3 times levered NASDAQ, QQQ. You can only imagine how much money people were making, day traders, etc., on the TQQ, since last autumn, okay? I finally decided, you know what? I know enough about this stuff. Maybe I can participate. So, made some money on this type of thing. But, another way to look at this, say, okay, TQQQ is a triple long. There's also a triple short. And literally, I bought this thing this morning, okay? Went to kind of prep for this and, already doing okay. These are kind of counteracting each other right now because it's all different time frames. And that's the thing with options. I'm getting into the trading part of it now, a little beyond, the sort of patient, longer term stuff I do before. But I think it's important for you to know what the potential for using these things is. Okay. Anyway, so let's decide. Let me see. And just to show you how much of a sort of experimental account this is there anything that anybody on this call thinks is going to go up or is going to go down sharply, oh, let's say over the next month. Pure opinion. Anybody? Because I'm gonna buy an option. All right, let's see. Let's do this with the stock. Let's look at the Dow. Some of these are liquid, some of them are not. I will go in and it's the easiest way to do it. Okay. This is the Dow. And I'm going to chart very quickly the Dow. And I want to try to find something that either looks really good or really bad. All right. So I'm going to write down here. I'm going to buy a call on something and I'm going to buy a put on something. And then we'll finish up. And I'll take a few notes as I go. And this is really kind of giving you a insight into my process. And it's not a trading process. I mean, I do the same thing with investing, different time frames, but this is how I bring it all together beyond the fundamental research. You know, this is the live stuff. Okay, well, that doesn't look great for Apple. I do already have some NASDAQ exposure, so in NASDAQ's Apple's so big. Okay, let's see. How does Amgen look? Amgen looks like it could probably go a little bit higher. I'll just write that down, although I don't think that's the one I'm going to use. Okay, Amazon, I've heard that one before. You know, it's falling, but I still kind of see it in a range here. Let's see. Let me just quickly flip through. Okay, so Caterpillar, getting a little bit worn out. All right, I'm looking for something that's really like a, let's see. Let's go CVX. Okay, CVX looks halfway decent. I don't think I have any energy exposure, so I will buy a call option on that one. Let's find now. Look, the Dow these days has a bunch of stocks that look great. It's the other stuff. I mean, and by the way, you know, since I talk about my best and worst moments, I made a little bit of money on Intel call options from here to here. But I was too impatient, and I said, let me just consolidate a little bit. So, you know, missed out on a good run there. I tell you, these Dow stocks, I mean, you know, McDonald's bouncing off a bottom. Merck doesn't look great, but let's see. Okay, Microsoft and Apple both look a little weak, but it's kind of hard to bet against those guys. Let me see if I can find another one that's just really looks like it's about to crater. Nope, not really. Okay, so I will use Apple on the put side, and I will use CVX on the call side. So I have to actually go back to this. All right, let's talk Apple. Now, I mean, this is just the system I use, all right. I'm going to go out a little further than this. And just to show you, I was talking about liquidity. So I want to buy call options. Apple is trading at, I'm sorry, I wanted to buy put options on Apple. Okay, so in round numbers, trade, what are 228? So let's see, how far could this fall? I don't know. Let's say that if it falls below 220, maybe that's where I would get, you know, I'd like to profit. Now, I'm going to go even further. I'm going to say that between now and the end of August, the market really takes a header, as they say, and Apple gets crushed below 200. All right. So that means I'm going to buy Apple August 30 expiration put options to open because I'm not getting, you know, I'm starting a position. And look, this is not the tightest spread you'll ever see, but whatever, 75 cents to 82 cents. Okay, not the most liquid market. So what I can do is I can go back here A lot to learn about the options calendar. Okay, August 30th, I mean, there are stocks and ETFs that trade in weekly options, even daily on the S&P. This is the regular monthly. And so if I go here, the mechanics are, well, I'm not risking as much time. At the same time, I need this to happen quickly, but there's a lot more volume here. See, it's 28,000 contracts are out there, a lot more than the others. So that's what I'm going to do. I'm going to buy Apple puts August 16th expiration, just writing that down, 200 strike. And just so you know, if Apple falls another 5% in the next week, these things will be wildly positive because we're still that far away. Again, time frames are everything. Okay, I'm shrinking it down to a very small time frame, and this is kind of, the first lesson, if you will. All right, so how do we go and do that? And obviously, everybody uses different brokers. Okay, so Apple put buy to open. That was our strike price. I'm sorry, that was our expiration date, 200 strike price, okay? And this is the other thing. Look, with my option stuff, especially in this type of account, I mean, tiny, tiny amounts of money, okay? So here, I'm gonna take let's see, because this is one I probably would do anyway, but all right, so I'm gonna buy 5 contracts, all right? And so to the extent that I still hold these, if you ask me, in a week, 2 weeks, whatever, all right, hey, do you still own? All right, well, here we go. Bought Apple. So I'm looking for Apple to start sinking toward 200. I'm putting up $270, and we'll see if I do anything. I'll see if it makes me anything. Okay, here we go. And if I simply toss this around, Schwab is really good with executions. There we go. It's in the portfolio. Okay, I'll do one more just to give equal time. CVX, Chevron, call options. And again, I've kind of done so much of this now that I kind of have a feel for what I want to do, sometimes without looking at the chart. I will go to that same place. Chevron's trading at 160. Look like it has some upside. So let me look at 165. Nah, too expensive. I love to find options that are like $1 or less per share. In other words, I'm trying to hit little home runs with these things. There's so many nuances to this. Okay, so I'm going to go to 170. All right. So in other words, I need Chevron to kind of get its butt in gear and start to get close to 170 in the next week or two, or moving up towards 170. But by the time we get to a month from now, if this is costing me in round numbers $1 a share or $1 a contract, if Chevron's worth 175 at that point, oil spikes, whatever, 175, the option at expiration will be worth $5. It'll be 5 times my money. The break even for me would be 170 plus the dollar I spent. So if CVX on this date is at 171, it's a wash. If it's below 170, I lose what I put up. And if it's at 180, I have just made 10 times my money. All right. So that's kind of how the mechanics go. I'll buy a similar amount here, just a few contracts, an example, put it through. And look, I mean, one way to think of this is, Rob just took a little bit of money and decided that he was going to execute what essentially is what they might call in the hedge fund world a pairs trade. I expect CVX to go up, Apple to go down. And even if one did better than the other, I probably could make some. All right. And then obviously on the sell side, I could just go in, sell, take a profit, etc. And I'll look at this again. Okay. So we covered a lot here. And thank you for staying with me. And like I said, I've never done anything like this before. I mean, this really was like, live and in session. So here's where I am counting on your feedback. If you're really shy and you want to send me a note instead, fine, but I would prefer to just hear from you. What do you think? Because I'm happy that I spent 2 hours of my day today trying to help people understand or understand better how all this stuff works, because I think it is a very important skill either to practice or to at least understand it well enough so that if you're part of the institutional service, or if I started some kind of option trading advisory or something like that, that you would know how to take what I'm talking about and do it yourself. So, again, kind of the idea of ETF yourself, except it's not with options, right? Learn how to construct portfolios using ETFs by yourself. That's what it stands for. So some feedback, and then we'll go back to what we were doing.
Hey, quick question. I mean, do you ever let options expire worthless, or is that not the same situation here?
Yeah, it's actually a really, really good question. Let me see if I can give you, I'll give you an example in this current portfolio. Obviously, I'll look for the one here. Okay, so this one, all right. Now, look, we all know that the NASDAQ has rallied from the floor, okay? In the last few weeks, I've probably seen more options that were down 80% from cost, and I ended up selling them as a profit than I've ever seen in my life. That alone says that there's something a little different about this market. And, watch when we get into September, October for the election. I think it'll be a different type of freak out every day. And not just every day. I mean, it will feed into weeks and months. I mean, I'm seeing it in the charts. So, this is one that, look, maybe TQQQ will fall off the floor. I don't know what it's selling for right now. Just check that quickly because I think it's good context. Okay, the Ultra Pro is at 74. Okay, a couple days ago it was at 85. So no doubt in my mind that it could get back there, but maybe this time is different. So I've got 3 weeks for this to go. Well, I've already lost $826 out of 1,000. Had a lot of winners with this thing too. Not that concerned. But let's look at the reward risk here. Okay, that's what I always do. The NASDAQ's got 3 weeks to rally, and if it does rally, it's going to be fierce, because everybody who thought that they could that there was another buy the dip, okay, and didn't buy all the other dips, will buy this dip. Not just traders. I mean, like, everybody's an investor now, right? Everybody has an opinion. It's gone mainstream. I remember when it wasn't this way. So I'm looking and saying, all right, am I going to just take a loss here? Probably not, because even if it continues to fall, this is what I would call a $172 lottery ticket. We call them lottery tickets because of all the things in my portfolio that have a chance to grow tenfold in the next 2 to 3 weeks, it is this one. Now, it's not likely, okay? Kind of like when I talk about my rating service for, my technical rating service. This is what I would call something in the red zone. High risk, high reward, okay? Now, the fact that I have 2 of them, and one of them is 90, and this one goes a week longer, and it's 100, my guess, I'll probably keep them both. I might, at some point, I might just decide to give up on one of them. I doubt I'll give up on both. So, that is when I sell, and in terms of before expiration, I mean, remember, I told you that UDAO, I think I started at 90. I sold some 90 call option. I bought some 90 call options, sold it for a profit. I put some money in, and I'm not a poker player, but you know how they say, okay, you put $100 at the table, you win $100, you put 100 in your pocket. I've just put my cost in my pocket and I'm playing with house money. Okay.
Mm.
I do that all the time with this. So I'll bet that within moments after this call, I will probably take that profit and I will roll it up to 105. I have to look at the chart. Maybe I want more time. Volatility has a lot to do with this. The one thing about options that I didn't mention is if volatility starts to like spike through the roof, all bets are off because they all become way too expensive. And one thing I'll want you to watch is the VIX, because it has been a minute since the VIX has started to show, and this thing is very inconsistent, all right? What this basically means is the annualized volatility of the S&P 500 was expected to be about 12%. Well, now it's close to 15. By the way, fun fact, there are options on the VIX.
Jeez.
Okay.
Yeah.
So the volatility of volatility. And by the way, I mean, you want to talk about home run upside? Okay. How about the VIX is at 12, and then all of a sudden the pandemic comes along and it goes to 83. Imagine if you own call options on the VIX, you've made like 10,000 times your money.
Yeah.
So
So with the volatility, you said that when it's more volatile, they don't cost you more. So it's better to buy the options before the volatility spikes. And you need them
well,
then.
right. And frankly, one reason the Dow looks so good to me is because it has lower volatility in general. Those NASDAQs are going to get tough to have in here very soon because the NASDAQ will get too volatile. So the Dow looks okay. I mean, look, I might get to the point where I just can't use the options, or when volatility is really, really high, you have to think less about buying them and a little more about selling. In other words, I might say, oh, okay, I've got a stock position that's way up. Here, we'll take an example of an international paper. All right. So I own international paper in the portfolio. I've had this whole move occur since I owned it. Well, maybe I play chicken with the market on this. I say, okay, volatility is so high. If this thing gets to 50 in the next few months, God bless. I can always buy more. All right. But if they'll give me, I don't know, let's see, what would they give me? Let's say October, call options, $50. I can get $1 a share. So, if for every 100 shares I own, they'll pay me $100 right now, and all I have to agree to do is to sell IP, 100 shares of IP for 50. It's selling for 46, and if it goes up to 50 and I still think it's going higher, guess what? I will buy more shares to replace the ones that I'm assuming are going to get called away. So that's how you use volatility the other way, because if things get really crazy, this one could go to 2 or 2.5, maybe even $3 in a week. And now you're bringing in the money. But I don't want to get all over the place. I probably already have, but this is the first time we've done this. What I'm truly, let me say it one more time, truly looking for from everybody who's on this call is feedback, direction. Okay. I could spend an hour a week, whether it was this subject or other stuff. I could spend 3 hours a week doing this if I thought that it would create a community. Yes, a community of subscribers, institutional or some version of that. Okay. So I would charge $300 a month for it because yeah, I can show you the portfolio. I can't give you personal advice, but I can lead the investment committee, if you will. And frankly, you know, that is what we want at Sun Garden more than anything else. I've never been a mass market type. I'm looking to basically create a do-it-yourselfer investment committee where I'll lead and you know, and everybody else can learn. There's a cost of admission, and you know, but I think everybody will feel a lot more confident because lessons like this will be, you know, going on regularly, and then we'll have the, you know, the back and forth, and everybody gets to know. That's what Emma and Dana and I really ultimately would love to develop. And so, you know, any other feedback on today? If not, really, I won't say you have to, but I'll almost say I really would like it, you know, and especially if you don't sign up for institutional soon. I would love it if you could just tell me what did you think? What else do you want to know? What should I stop talking about? Should I put a 20-minute timer on it and, you know, not cover as much? I mean, whatever. Okay. Let me know, because the absence of feedback probably means that we would do less of this. And the more feedback we get, the more I devote my time to this, and squeeze some time away from managing my own money, doing my writing for different places, and all the other stuff that keeps me busy in alleged semi-retirement.
Cool.
All right. Anything else for now? Otherwise, does anybody have anything like, hey, you know, this was a good part of it. This was not a good part. I'm not looking for praise. I'm looking for constructive feedback so we know what else to hold these sessions about. Anything else?
Yeah. No, thanks, Robin. I gotta get going, but no, I like sort of seeing, you know, the actual live calls and puts you had on the portfolio to sort of see, you know, how you're really using it in practice there.
Yep.
And I still got to get my head around the call and puts, just go off and study and watch some more videos.
Yeah. I mean, there's a lot of
you know,
basic stuff that you can find, and but you know, try to take everybody through everything. We can always take this and break it into parts if we need to. So, all right. Thank you all for tuning in. All right. See you soon.
Yeah, thank you. Okay.
Thank you.